Good afternoon, and thank you for joining me for this month's SURF webinar. In today's session, we will talk about mostly the addition of the new equity manager to the Signature range. But as usual, I will touch on just the summary of the investment strategy of the umbrella fund. I'll also talk about positioning. I have a couple of slides where I will give you an overview of economics and markets. And then lastly, we'll look at the performance as well as the latest Alexander Forbes surveys, so we can have a look at how the portfolios are stacking up against all competitors in the space. So without further ado, I'll start off with our mission and vision statement, and it really is to create a retirement fund that is able to restore the confidence in the retirement fund industry through, being innovative and really making it easier for all of our members to save. And we want our members to be able to have life-changing and dignified retirement outcomes and to build a more financially secure South Africa. Looking at the default investment strategy, it is a life stage model that's implemented by the Board of Trustees, and each management committee can choose one of 3 different life stage options. Despite what the management committee may choose, members will still be able to opt out of the default investment strategy and invest in their own portfolio should they wish to exercise member investment choice, and there's no limitation or cost to switching. Now, the life stage model, whether it's the Skeleton Signature or Synergy range, all starts de-risking members from 6 years to retirement until 1 year before retirement. So right up until 6 years, members will be investing in a more aggressive portfolio, and in those last 6 years, we start de-risking them so they go into more and more conservative portfolios until 1 year before retirement. And looking at these 3 ranges, the differences really are, whether they're active or passive, and specialist or balanced approach. So the Skeleton range is the low-cost range. It is 100% passive, and there's no active manager. The Signature range is the one that I will chat to you about today, predominantly, and the Signature range is the range that is a blend between active and passive management, and it's in this range where we have made a change to one of the active equity managers that I'll chat to you a little bit later on. And then the last range is the Synergy range. It is active on the local side, and then the offshore component of all 3 of these ranges is passive and exactly the same. Looking at the risk and return profile of all of these options that we offer, as you would expect, the higher the risk, the higher return over the longer term. So members are advised to be invested in the 70 portfolios for the majority of their working lives, which is how the life stage model has been created. And you'll see that the 70 portfolios are further to the right. So we do expect more risk, more volatility, more ups and downs along the way, but over the long term expected to give us the highest returns. Those together with some of the single manager portfolios. The further left you look, the more safer portfolio is, but not expected to give you, very high inflation beating returns over the long term. So let's chat about this addition of the new manager. The last time I showed you the slide when we looked at the Signature range and the makeup of the Signature range, we noted that within the equity space, within the bond space on the local side, we do have a blend between active and passive. So in the local equity space, the Sygnia Swix tracker is the passive component. That is the component that just simply tracks the Swix index. And then we have a number of active managers. Now, when we looked at the slide as at the end of March, we noted this blue building block that said the equity transition portfolio. So this is when we were moving from one manager to another. And the new manager that we have actually added there is Laurium. And I will chat to you a little bit about why we added this manager and what they bring to the portfolio. But if you look at this manager lineup on the local equity side, so South African equities, you've got your Swix tracker now that's tracking the index, and then you have 4 different active managers. And what's quite nice to see is that 2 of them are large, very well-known managers, your 91 and your Coronations. They've been around for many, many years, definitely household names. And then you've got 2 boutique managers. So boutique managers do add a lot of value to the investment process. They, are more nimble, can get in and out of certain opportunities. So it's quite nice that you do have a blend between these two bigger managers and two smaller managers. So it's not to say that all four of them think in the same way or have the same processes and philosophy. In fact, the total opposite. They have all been chosen for a different reason, as they do bring a different element to the portfolio. There has been no changes in the rest of the portfolio. That's why we haven't highlighted anything else. So thinking about that South African equity building block, as I mentioned, you do have, at the core of it, you've got that passive component that's going to give you the market return. But in addition to that, you've got the active managers that are providing that opportunity to outperform. So we often speak about this core satellite approach to portfolio construction. And again, even within each building block, we can think about it in a core satellite approach kind of way, where, the core of the portfolio is giving you that market exposure at low cost. And then the active managers are providing that opportunity for outperformance. The reason why we're not adding just one active manager is because we know that there's not a single asset manager strategy or style that is expected to consistently outperform through time. Therefore, multi-manager portfolios, a portfolio that's made up of more than one manager, is already more diversified across styles, and in that way can also minimize risk. So this blended approach between a number of active managers together with your passive core can give the investor this opportunity for outperformance of the benchmark, but at the same time keeping costs relatively low. So that's the reason why we constructed in that way. So when we're selecting these active managers, there's a big team, at Sygnia that, focuses on this very important project. And I will, not go into too much detail, but I just want to show you some of the names and some of the, some insights behind this manager research process. The investment team is led by Ian and Carl, both of them very, very experienced, many years in the industry. But behind these two gentlemen is a very, large and experienced team of investment professionals that assists with this manager research process. And the way that we have organized ourselves from a responsibility perspective is we have core managers that are included in our solutions. And some of them are local equities, some of them are local fixed income, so your bond managers, some of them are balanced managers. So if you think about the Synergy range, those managers are balanced, meaning that they look after, different asset classes as well. And there's a person responsible for each one of those, different categories of managers. And for the core managers, the ones that we do use in our solutions, we do have monthly contact with them. We have quarterly, very in-depth presentations. We do monitor, their performance and their holdings and a lot of information on a daily basis. And then for the other managers that we, sort of just keep an eye on from a research perspective, we do see them a little bit less frequently, and the monitoring that we do on their performance and holdings is a little bit less frequent. But it's not to say that, once we have chosen our managers, that's the project done, and we never think about, whoever else is in the South African and the global markets. We are constantly trying to keep up to date with, what asset managers locally and globally are doing, even if we don't actually invest in them. So from a process perspective, this little pyramid summarizes it quite nicely. How we start off the manager research process is usually we kind of know what we're looking for. So I mentioned that in the Signature range, we now have 2 large managers and 2 boutiques. So we were specifically looking for a boutique manager to complement the other boutique manager, which was Visio. So sometimes we may be looking for boutique managers. In certain instances, you may be looking for a large manager. Sometimes you're looking for an emerging manager, which are more your smaller type of managers that have just started out. So in this instance, we were looking for a boutique manager, and looking at all the boutique managers in South Africa, there was actually 126 of them. From there, we, thought about what is important to us. Will it be certain ESG considerations? Will it be whether they can manage Sharia compliant portfolios, for example? How important is BEE? Do we want a specialist mandate? Are we looking for a balanced mandate? In this case, it was a specialist mandate. Are we looking for a certain style of manager? And that style could be value, growth at a reasonable price. Other managers are what we call contrarian managers. Other managers are totally style agnostic, but very good at trading. So you consider all of those elements. You also consider whether these asset managers have in-house research or whether they pay and rely on external broker research. So when you consider all of those items, you are able to actually filter that list, down from 126 managers to, a few less. Then on quite a number of them, we do perform quantitative analysis. We request data, holdings. We try to analyze, how they behaved over the last couple of years. So that's more on the quantitative side, looking at the numbers. And then we look at the qualitative side. So who are really the key individuals at these asset management firms that are making the decisions? What is their experience? How long have they been with the firm? You look at the business itself, how it's structured, do they have succession planning, all sorts of issues more on the softer side. We call that our qualitative analysis. So after that, we then filter down this number of managers to an even smaller amount, and on our shortlist, we'll perform an in-depth due diligence process, and then we'll come to a decision whether we want to buy the manager, hold the manager, or sell the manager. And you might make the decision to appoint somebody like a Laurium in this case, for example, but then based on this due diligence process, you might also have a number of other managers that are now on your shortlist. So should another project come up, or should something happen where you want to maybe replace one of your existing managers, you do have that shortlist that you can go back to, and then start from there. And you continue to monitor these managers quite closely. So really, I gave you the summary of this process in a snapshot, but broad themes are identified by us over time. So at times we think boutique managers may do better. There's certain market environments and portfolios where larger managers make sense. Sometimes we're more interested in certain sectors of the market. It may be resources versus financials versus global, small versus large caps, in-house versus broker research. And based on those types of themes, we can then know exactly what we are looking for. And we look for certain managers that are able to actually suit these themes that we think will play out in the markets. And when we have the meetings with these managers, we typically meet with the chief investment officers, with portfolio managers, with analysts, in fact, with as many of the team members as possible. And we perform, as I mentioned, the quantitative as well as the qualitative analysis. And it's not to say that we only perform this function when there's a need for one of the portfolios, but this is actually something that is ongoing at Sygnia. We have quarterly meetings with a whole lot of different managers regularly, whether we have a project to change a manager in a portfolio or not. And there's many managers that we do see, local managers as well as global managers on a quarterly basis. Once the shortlist is generated, as I mentioned a little bit earlier, once you've thought about, all sorts of things such as styles, ESG, BE, we then perform this operational due diligence, the risk management due diligence. We do want to meet as many of the team members as possible in follow-up meetings, and then we undergo fee negotiations. Fee negotiations are very important, as the lower the fee that we can agree with the manager, the lower the ultimate overall fee of the portfolio. And then when we perform the quant analysis, it's very in-depth. We use, a number of systems. We model, the portfolio as much as possible, try to look at historical data, try to look at current data. And, we really do go very in-depth to see if the manager, in the past, through certain economic events, has actually behaved in the manner that would have been expected, depending on what they're saying their process, philosophy, and thinking is. And then proposals are taken to the investment committee, which is chaired by 2 heads of investments. There's a representative from each asset class, and then a decision is made on whether to make any changes to the portfolios. Now, I'm sure you would have seen this chart before, and it really shows us that it's very difficult to choose, one active manager that is consistently able to provide you, top performance, through the years. That is why in that local equity portion of the signature range, we do use a blend, not only between active and passive, but even within the active space, you do have 4 different asset managers with different style, different processes, different thinking, and we've blended them in such a way that we believe they can add value throughout different market cycles. And this chart shows us that, certain managers may be at the top of the ranking tables, over the 1 year, but then, be at the very bottom again over the next year. And that's why diversification within active management is really, really important. And this is where multi-manager portfolios can be very beneficial. So looking at this well-diversified building block, so the Sygnia equity fund portion, you now have the Sygnia Swix tracker, as I mentioned, and you have these 4 different active managers, which is Coronation, Visio, 91, and Laurium. So Laurium is the only new one that has been added over the last little bit. So let's chat a little bit about Laurium and who they are. Now, they've been around since 2008. They've got 35 billion of assets under management, a very large and experienced team. We found them all very professional. The team itself has a very low turnover, which is something really positive that you look for on the qualitative side when you're assessing different asset managers. Because you want to know that the team is stable, how they think, how they, think about certain, stock picks, for example. So that's, stability of team is really, really important when you're trying to assess asset managers. They also have an extensive networks and very strong relationships in South Africa, which is really important. So they may have, strong relationships with boards at Woolworths, for example, and, that can give them good insights when they're trying to price, that stock, for example. They do also outsource all the non-investment related activities. So they're not trying to, worry themselves with IT and, certain other functions. They're purely focused on investments, the investment process, and what stocks should be in the portfolios. Everything else that a company needs to run a business is actually outsourced to companies that are experts in those fields. Again, very positive, as you know, that they're very focused on, the job at hand, which is to create a nice, investment portfolio of stocks that makes sense. They do apply negative screening to companies from an ESG perspective. So should something be flagged about a certain company, be it on the environmental, social, or governance side, they will flag it, and they do negative ESG screening. So that means that a company can be excluded based on something negative. So if, for example, they're polluting the environment, they could be excluded based on that. But in addition to that, they also try to do positive ESG engagement. So one of the examples, has been that the portfolio managers met with the board at Woolworths, and they were instrumental at making sure that they stopped the use of the plastic bags, and rather use these bags that we all have now that can be reused over and over. So that's an example of positive ESG engagement, when these portfolio managers start having very good relationships with board members at companies, and they try to influence the business in a positive way. And it could be environmental, it could be on the social side, more around staff and communities, and it could be on the governance side. So they don't just stop at looking at negative screens. They also have sector specialists. So what that means is that within the investment teams, there will be individuals that are just focused on financials, others that are just focused on resource stocks, others that are focused on industrial stocks. when you have sector specialists, a lot of companies that are in a specific sector will have a lot of things in common in the way that you kind of analyze them. So they have specialists for each of those sectors. When we looked at their data historically, they have added a lot of outperformance over the capped Swigs, which is what they benchmark themselves against. They have quite a concentrated portfolio relative to other mandates, because this is one of 4 active managers together with the Swigs in the portfolio. Having too few stocks, isn't, concerning this stage, but it is, it shows us that it is a high conviction type of portfolios. And, from all the managers in the shortlist, they did seem to have, the most established process and structures in place when compared to everybody else that was on our shortlist. We have actually worked with them before, many, many years ago, in the hedge fund space. So, we do know them and have thought, good things about this manager throughout all of these years. And then from a style perspective, they are bottom-up fundamental analysis, and they do have this macroeconomic overlay. So what's going on in the world, as much as they're bottom-up and we look at stock specifics, what is going on in the world does play about a 20% role in the ultimate decision making. So that's just to tell you a little bit about them. And as I mentioned, they are one of 4 active managers. So if you look at these 4 active managers, they are all adding something different to the portfolio. So 91 and Coronation are your larger, more established asset managers. If you look at long-term performance numbers, which we'll look at a little bit later on, these really are the managers that have consistently provided us with good returns, and that consistency of good returns can be seen in the 7 and 10-year numbers that we can show you. 91, what they bring is really they're a very well-resourced team. They do have, colleagues outside of South Africa that they have direct access to. So it's very different to be able to, phone up someone that, maybe sitting in the US to tell you really what is going on the ground. And they have that, really worldly perspective. From a style perspective, they invest in companies across all market sectors where profit and earnings expectations are rising. And valuations are reasonable. Coronation, on the other hand, also established, strong team, definitely a household name, very large asset manager in South Africa, top performer over the last couple of years, constantly at the top of the ranking tables. They do have very high conviction views, and from a style perspective, very much, in the long-term valuation-driven philosophy. Visio, if we then look clockwise, Visio was added in the portfolio last year, so also one of the newer managers. They offer great downside protection. So whenever we, analyze their data and markets were down, they can provide that a little bit more security on the downside. Also a boutique manager, which is great. Smaller managers have more opportunities to be able to buy in and out of the small and mid-cap space. They do have, really good fees, and also an extensive ESG process and risk management, which we find really, really important. And then Laurium, the last one, as I mentioned, I know I covered some of the points, on the previous slide, but from a style perspective, bottom-up fundamental analysis, they do have that positive ESG engagement in addition to negative ESG screening. Another boutique which comes with its benefits, as I mentioned, and their portfolio is actually, quite concentrated, but a high conviction portfolio, which adds a nice element to this blend of active managers that you have. So that's, really the summary of the change that has taken place. So, now when you do look at some of the detail of fund fact sheets or, any other communication that you may get from the fund, you will see that Laurium is in the manager lineup of the Signature range. In the Skeleton and Synergy range, no changes have taken place. Of course, we know in the Skeleton range, there's no active managers. And in the Synergy range, the managers are active, but it's the balanced managers that are hired for a different skill set altogether. They manage, equity, bonds, property. They're multi-asset types of managers. So from a strategic asset allocation, the strategic asset allocation of the portfolios remains the same. And in the positioning, when we're thinking about, the skeleton signature range and even the offshore portion of the synergy range, we really are thinking about it again in a core satellite approach kind of way, where the core of the portfolio is your more traditional asset classes. We're using passive where possible. And our views are to be underweight SA equities, overweight bonds, overweight global equities, and underweight global bonds. And then you have a number of thematic satellites that are added there to provide that opportunity for outperformance. And those are global real estate, disruptive technologies, emerging markets such as China, Asia, Asian economies, investments into health, so specifically global developed market healthcare, and then value, which is a shorter term satellite, really added to take advantage of the rising interest rates. So as I go through economics and markets, which I will go through, very briefly, that really is what informs our positioning into these satellites. So looking at the skeleton range, as I mentioned, there haven't been any changes here. There's no active managers. This is simply the range that is made up of low-cost index tracking type of products. And it's really on the global side. If you look on the right-hand side of what I'm showing you on the slide, that you're seeing, all of these themes playing out that I showed you on the previous slide. So in the international portion, we're not simply saying, let's track one, diversified global index. There's a lot of thought that goes into, what themes do we believe will really add good growth to the portfolio over the long term. So it's here that you can see, these value ETFs, for example, and value as an investment style is a style that tends to do well when you're in a rising interest rate environment. You see the emerging markets theme, where you see specific instruments that are tracking, China or other emerging markets. You see your health theme. So as I mentioned, we do believe in health over the longer term. So especially developed market healthcare companies. So you see the Health Innovation Fund. From a tech perspective, you've got that small exposure to the Fourth Industrial Revolution Fund. You've got your global property. So it's really here on the global side that we're seeing the thematic exposure take place. And then no changes to the synergy range. So as much as these are active managers, as I mentioned, they are multi-asset, balanced managers. So the Alan Gray, for example, that manager will manage South African equities, bonds, cash. So they've been chosen for a different skill set altogether. So they've been chosen for their skills to be able to manage across all the asset classes. And the lineup of the synergy range is still made up of Alan Gray, Coronation, 91, and Prudential. And then quickly touching on economics and markets before we move on to having a look at some of the performance. April, very short term, to look at, just 1 month as a snapshot. It is very short term, especially in the retirement fund context. But nevertheless, I wanted to show you that, again, the last, full month of data that we have has been quite a volatile time in the markets. Equities have not done well. If you look at the red bars on top, there's only really UK equities in rand terms that have performed well. The thematic satellite, so if you look at that core satellite approach graph that we just went through, there's a number of themes that we're following in our portfolios. And some of those themes have done well, such as value. So value tends to do well when you are in a rising interest rate environment. And value indices are really indices made up of stocks with low price to book, low price to earnings, and high dividend paying stocks. Value as an investment style is the opposite of growth. Growth really is your growth companies, or companies such as tech, and they tend to do poorly in a rising interest rate environment, which is why, from a theme perspective, if you look at the Fourth Industrial Revolution Fund, or FANG Plus, These are your tech kind of indices, and they have done poorly in the month of April. What we're also noticing is that China and emerging markets are not doing as bad as some of the other regions, which is also positive to see. So there is a bit of a comeback on emerging markets. And then lastly, we can look at the yellow kind of bars, and over there we can see that these are more your safe haven type of assets. And when you have this risk-off environment, when there's a lot of nervousness in the market, we can see that, you know, people prefer to be invested in safe haven assets, and those are the ones that have actually done well. So it's your cash, it's your gold, more your safer type of asset classes. What we've also seen in the markets is, you know, we look at various, you know, indicators as signals as to what could happen in the markets, and investor sentiment, so how investors are really feeling, you know, in the investment markets, is sitting at basically an all-time low as it was after the global financial crisis in 2009. And from a signal perspective, this very often actually signals a good buying opportunity in the market. There's been a lot of focus on interest rates in the United States and the high inflation that we have seen in the United States. So inflation there has been hitting all-time highs, you know, 8.5% year on year. However, core inflation, you know, looks to be, you know, at its lowest level, which is positive. So it almost looks like inflation is actually peaking. And when you have this high inflation, you know, of course, the Federal Reserve does raise interest rates, and the last interest rate they raised by 50 basis points. It was largely expected by the market, and in fact, the market has priced in about 270 basis points of interest rate hikes. You know, we may, for the remainder of the year, see other hikes that are, you know, 50 basis points at a time. The Fed did say that they're unlikely to hike, you know, at 75 basis points or more in one single meeting, but you know, we had to see what will happen, but very well priced into markets. Overall, looking at the United States as a region, and if you look at our positioning, we are underweight the US relative to a global benchmark, which is the MSCI ACWI. So as much as it's still, you know, our largest positioning, we are underweight. And the reason that we're underweight is for quite a long time, we have been worried about valuations. You know, certain stocks, especially tech stocks, have been very expensive. And if you look at this diagram on the right-hand side, we can see that, you know, Tesla, for example, is, you know, one company, but from a market cap perspective, much bigger than, you know, all these other car manufacturers put together. But if you look at their revenue at the bottom, you can see that the revenue is a fraction of the revenue of these other companies combined. And you may argue that, yes, you know, electric vehicles are the future, but it's not to say that these other companies are also not working on electric vehicles. They certainly are. So we have been very worried about valuations. We're worried about, you know, the dollar, and of course, this rising interest rate environment. So we are sitting slightly underweight the US and finding other better opportunities elsewhere. And in emerging markets is then a position where we've been overweight. So overweight again, relative to the MSCI ACWI as a benchmark. And emerging markets have been a very tough place to invest. It's been very volatile over the last year. You know, the Chinese governments and regulators have really, you know, put forward, you know, regulations that have affected tech stocks, the gaming sector, the education sector, which have impacted stocks such as Tencent, which have then in turn even had an effect on our local market via, you know, Naspers and Prosus. So there's been a lot of volatility, but now they, you know, really putting in this all-out effort to support the economy. to support markets. Where everybody else is in a rising interest rate environment, they're actually cutting rates to stimulate the economy. And we're seeing, you know, much better numbers coming out of emerging markets over the last month or so. So despite the volatility over the long term, we're still finding emerging markets very attractive. And from a valuation perspective, you know, due to the sell-off with the reaction to the negative news around tech regulations, it was a good opportunity to actually top up some of the exposure as they were looking very, very attractive. And then, of course, the war, unfortunately, is still ongoing since the end of February. So it really has been, you know, probably the most top of mind issue for 2022 since the beginning of the year. It has resulted in higher energy prices. These higher energy prices are influencing inflation. Everything's becoming more expensive, you know, heating, it's filtering into, you know, food prices. Russia and Ukraine are not only, you know, large producers of a lot of, you know, the crops, but even just, you know, of course, transport going up then has this knock-on effect on food prices. So the longer that this war goes on, the longer that we can continue to see its effect on both energy as well as food prices and ultimately inflation. So we do foresee that we're going to be seeing higher energy prices for longer. You know, it's very difficult to say how this war will end, where it will end, but there seems to be a little bit less nervousness around whether it would spill over, you know, beyond the borders of Ukraine. And the consensus is that, you know, it will remain, although, you know, impossible to tell, that it will remain, you know, just in Ukraine and not really spill over the borders. But definitely a top of mind issue that is affecting markets all over the world. And then, of course, locally, we do invest a huge portion. The largest portion of the portfolios is invested in South African assets. That's in South African bonds as well as South African equities. Now, you saw in my slides that we underweight South African equities and overweight South African bonds. In the bond space, we do feel that, you know, risks have been priced in. South Africa is still offering some of the highest real yields in the world. So in the bond market, it does make sense to be overweight the South African bond market. But in the equity space, I mean, there's a lot of headwinds. We're still suffering with load shedding. You know, we've unfortunately had these natural disasters in KZN. That means that the country has been put into a state of disaster again. And a state of disaster is can be positive in the sense that money can be approved quite quickly to deal with very urgent issues. But we have seen in the past that, you know, these states of disasters are also used to, you know, take advantage of being able to sign off on, you know, various deals, and ultimately, you know, corruption takes place and wasteful money management. You do need a stable electricity supply, you know, for the economy to tick over, for companies to be profitable. So all of these headwinds, unfortunately, are the reasons why we slightly underweight South African equities from a positioning perspective. So lastly, I just want to cover then the performance. Now that we've had a look at, you know, the structure of the funds, where we have made changes, which is only in the signature range. We've looked at the positioning, the markets and economics that have informed that positioning. And now let's look at the performance of the funds. It should be no surprise that if you look at the first couple of columns, you're seeing a lot of negative returns. So as I mentioned, the first, you know, couple of months of this year have been really tough with the ongoing war, with rising interest rates, high inflation in, you know, regions such as the US and the UK. But if you look at the longer term numbers, and especially in the retirement fund context, we should always be focusing on, you know, 3, 5, 10-year plus kind of numbers. If we look at the longer term, we can see that equity markets have actually delivered quite nicely. And then the few things to point out just over the 1 year that will make more sense in the surveys is if you look at the difference between the SWIX and the capped SWIX, we can see that the SWIX over the 1 year gave us 8.8%, whereas the capped SWIX 14.7%. The difference between the SWIX and the capped SWIX is the exposure that these two indices have had to Naspers and Prosus over the 1 year. So the capped SWIX has a smaller exposure to Naspers and Prosus, whereas the SWIX has had a bigger exposure to Naspers and Prosus due to all of this negativity in China, how it's affected Tencent. It had a bigger impact in the SWIX than in the capped SWIX because the SWIX is more exposed to Naspers and Prosus. But in April, you can see that the returns are exactly the same, both of them at minus 3.9%. So now we are sitting with a situation where there's hardly any difference between the SWIX and the capped SWIX. But over the last year, if you were more exposed to Naspers and Prosus, because those two shares didn't do so well, and they didn't do so well because of all the regulations in China, unfortunately, that index is done more poorly. Our portfolios do track the SWIX, so we were impacted by this, but our view is that we understand where this volatility came from. The SWIX still has a lower turnover, so we do prefer it. There's less trading, less costs, which ultimately impacts the costs of these portfolios. Property also done very nicely over the 1 year at 12.2% in rand terms, but if you look at the 3 and 5 year numbers, still negative returning. So over the long term, it has helped our portfolios to avoid direct exposure to local property, but over the shorter term, if you compare our performance to the performance of portfolio that did have local property just over this 1 year period, then we have underperformed some of those portfolios. And then looking a little bit further down, if you look at the MSCI World Index in rands, that's global developed markets, largely, US. We can see that they returned 5.2 for the year, whereas emerging markets, biggest component of emerging markets is China, gave us minus 11%. But if you look at April, we can see that the tide has turned, where emerging markets are giving us 2.2% and developed markets are giving us minus 0.8%. So we are overweight emerging markets. And, over the last year, it has hurt the portfolio, but we have taken advantage, as I mentioned, from a valuation perspective to top up some of the exposure. And, it seems to be paying off now in the shorter term. So looking at these market returns and how they then translate into the performance of your portfolios, we can see that over the 1 year, the portfolios have done very nicely. We're seeing, the Signature portfolio giving us 10.6, Skeleton, which is the passive low-cost option, 9.1, and Synergy, 11.8%. You can see that the 60, 50, and 40 portfolios are all comfortably ahead of their strategic benchmark as well. And then if we look at the surveys as at the end of April, it's always quite nice to see how, these portfolios would have grown, or how 100 Rand invested in these various portfolios would have grown over the longer term. So what this chart shows us is if you invested 100 Rand into the Synergy 70, Skeleton 70, or Signature 70 back in May 2012, how that 100 Rand would have grown up until the end of April 2022. And we can see that, whichever portfolio range you have chosen, this 100 Rand would have grown quite nicely, not without volatility. You do expect volatility when about 70% of your portfolio is invested in the markets. And what's quite nice to see is that all 3 of these 70 portfolios are comfortably ahead of the black line. And the black line is the global large manager watch median, which is the median performance of the managers listed at the bottom. All very large, very well-known managers. So on average, you can see that your portfolios have done much better. And then looking at the surveys for various time periods, these surveys have been categorized in such a way that we're comparing like-for-like portfolios. So what we have in front of us right now is the low equity multi-manager survey as at the end of April. Now, all of these portfolios are low equity in nature, so they all have roughly 30 to 40% in, investing in local equity. So you are comparing apples with apples. And we can see that over the shorter term, the Synergy and Signature range of portfolios have done very well. If you're looking at the 1 year, the Skeleton a little bit further down. Over 3 years, the Signature 40 has been the best performing, and over 5 and 10 years, again, the Signature 40 portfolio has been the best performing. The Synergy does not have a long-term track record. That's why it has not been included in the 10-year survey. Then in the low to medium equity space, so these portfolios all have roughly, about 50% invested in equities. You can actually see it in the names of some of these portfolios, for example, Sanlam MM50 or Momentum Classic 5. Those numbers in the names of the portfolios are indicative of the rough equity allocation. And again, over the 6 months, we can see some portfolio ranges doing better than others. Over the 1 year, the Synergy 50 fund is at the top of the ranking tables. Over 3 years, it's the Signature that's, just a couple of basis points behind Old Mutual and Mentonova. And then importantly, over the long term, you really see that good consistency of returns, with the Signature 50 portfolio being the best performing against similar portfolios over the 10-year period. The 60 portfolio compared against similar portfolios, again, over the shorter term, depending on the portfolio range, some are closer to the top, some are closer to the bottom, but focusing on the longer term, we can see that over 3 years, it's the Signature 60 portfolio that's at the top of the ranking tables, and over 5 and 10 years, again, the Signature 60 portfolio has been the best performing against every other portfolio in this category. And then arguably the most important portfolios are the 70 portfolios. I say the most important is because most members default into the life stage model, and once they default into the life stage model, they don't actually make a move until we automatically start transitioning them to more conservative portfolios. So the bulk of SURF's assets are actually sitting in the 70 portfolios. So members are expected to spend the majority of their working lives being invested in these 70 portfolios. So over the 6 months, we can see that the Synergy is, closer to the top, followed by Signature and Skeleton a little bit closer down to some of the bottom performers. That's very short term. Over the 1 year, similar lineup between the three, different ranges, with the Synergy, top quartile performance, Signature closer down to the middle, and Skeleton, as a passive fund, over the last year, active management has worked, we can see the Skeleton 70 fund largely influenced by that exposure to the SWIX index, whereas other managers have benchmarked themselves against the capped SWIX, and the capped SWIX did do better. Also, the property allocation that I showed you, if you compare some portfolios that do have property exposure and our portfolios that didn't have any direct exposure to the local property sectors, those are some of the reasons for the short-term underperformance over the 1 year. But especially in the 70 portfolio, we should be focusing on the longer term, as we do expect members to be invested in these portfolios for the long term. So we can see over 3 years, Synergy and Signature, quite high up there at the top, just a couple of basis points behind some of the best performing portfolios. And although Skeleton looks, much further down at the bottom, this is, of course, gross of fees. So fees have not been deducted. Skeleton is cheaper than a lot of these, than all of these portfolios, actually, because they're actively managed, and on a net fee basis, it will be a little bit further up. And also, looking at the actual percentages from, in absolute terms, the gap isn't that wide over 3 years. Over 5 years, we can see Synergy followed by Signature and Skeleton, just a couple of basis points behind. And then over 7 and 10 years, we can see again over 7, it's Synergy that's at the top, but over 10 years, the Signature range, giving us 12.1% return over the last 10 years. Which is really great, and showing us that good consistency of returns over the long term. So these returns are annualized. So to interpret that 12.1, had you been investing in this portfolio, your return would have been 12.1 per year for the last 10 years. So really doing quite nicely. And then the Skeleton only 0.9% behind the Signature range over 10 years. And then to compare against the single managers, not really a fair comparison, but interesting nevertheless. I'm not really going to focus on the 6 months and the 1 year, as they're very short term, but what we can clearly see is that certain asset manager styles have managed to outperform and some have underperformed these more diversified multi-managed portfolios that we have. Over 3 years, interestingly enough, it's only really Coronation that's has managed to outperform, and every other single manager has really struggled. And then over 5, 7, and 10 years, again, we really just see, Coronation and 91 that stand out from a performance perspective, but the Signature 70 fund has actually outperformed all of these single managers over the long term, which is quite nice to see. And then lastly, on the comparison against managers, it's all good and well up until this stage. Looking at the survey, we've been focusing on these absolute values of returns, but we haven't really considered the risk. So it's important to also understand how much risk a portfolio is taking on. And when you increase risk in a portfolio, it means that there's more allocation to risky assets. So a portfolio that has more risk than another means that it has a high exposure to equities, to global assets, to hedge funds, to alternative investments. So the further right you look on the scatter plot, the more risky a portfolio is. So the more of those asset classes that will be included in that portfolio. And the further left you look, the safer portfolio would be, meaning that the portfolio would have, I say safer, meaning less risk, implying that there's more bonds, more, cash, more these safer type of asset classes, and less of your more volatile asset classes such as property, equity, hedge funds, alternative investments, etc. So looking at the Signature, Synergy, and Skeleton ranges, we can see that for every level of risk, they actually have done quite nicely. So essentially, for every level of risk, you want your portfolio to be plotting as high up as possible. Anyone plotting underneath that portfolio has taken on the same level of risk, but have simply not been rewarded for that risk taken. And a lot of the portfolios that are sitting very far to the right, you can see they're not all very high on top, meaning that, a lot of these portfolios have taken on a hell of a lot more risk than, the Synergy, Skeleton, or Signature range, but simply have not delivered as high of a return for the 7-year period. Ideally, we should actually be looking at this scatter plot over 10 years or even longer, but the reason why we have chosen to show you 7 years is because this is the period of time where we do have the most competitors in the space. As we saw in the surveys, when you're looking at the 10-year numbers, there's very few portfolios that you can actually compare yourself against, because you do have to have a real and actual track record to be able to, be included in the surveys. So overall, all three ranges that are offered as, default life stage models have done very well for the level of risk that they take. And that then brings me to the end of my presentation today. I hope that you found it valuable to learn a little bit about, the new manager that we have included in the Signature range. There's been no changes to the lineup in the Synergy or the Skeleton range of passive, just some insight into the positioning and what our thinking is with some of the key events that are taking place around the globe. So I don't see any questions that have been included in the question and answer box. And therefore, I want to thank you again for your time. And if you do have any questions, please do get in touch with us after this presentation. I'll be more than happy to answer any queries that you may have over email. So thank you and have a good week further.